Hi, and welcome to this week's IMAX FinTech Weekly Market Insight. As usual, start with our disclaimer. So, trading involves the potential risk of loss of capital. It's not suitable for everyone, although, as I always say, hopefully it is for you. Now, many companies will provide leverage, so just be aware you can lose substantially more than that initial investment that you make. All the views, opinions, everything that's contained in this webinar or YouTube is just purely for educational purposes. We're not trying to encourage you to trade or invest. That must be your decision. And before you make that decision, carefully consider that the risks that are involved, definitely your financial situation, your level of experience, but also your risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. If you've got any doubts whatsoever, then just seek some independent financial advice before you risk your capital. Always feel, free to reach out to us. We'll always help you and advise you for sure. Okay, so if we look at the highlights of last week, there was quite a lot going on. The markets ended the week strong, except for Bitcoin. The dollar was a little bit off of its high. It did get to a 105 handle for the Dixie, which is a dollar index, but it dropped back to the 104. In the US, durable goods, they came in mixed. These are the bigger ticket items. So generally, they've got a lifespan of at least 3 years. And of course, because they're the bigger tickets, if people are buying them, they're more confident of their earning ability and willing to spend it, of course. Home sales were better than expected. And I think that's really because Americans are just beginning to learn to live with those higher rates now. They accept that they're around for some time. If you look at it, double what they were, the mortgage rates for sure. And I suppose the added thing there why they have improved probably is because with the rates increasing, the fact is that buyers are being tempted by lower property prices where sellers are looking to exit. Chicago PMI was lower at 43.6, which for me is contraction level. And Fed speakers gave mixed views on interest rates. Some were saying that they expect sort of the rates to be ending, well, the increases in rates to finish by the summer. But again, they're going to be data driven, so going to have to wait and see whether they're right or not. In the US, also PMI was down to 47.3. Now, construction spending was down there, and also ISMs generally came in below 50 in Feb 47.7. However, the prices paid increased to 51.3, which was much higher than expected. So, there's still some strange things going on within the economy, and that's not going to go away at the moment, especially, obviously we're all concerned about inflation. In the UK, not too much to report last week. Consumer credit was increasing as inflation continues to impact household spending. They're having to make tougher decisions on where they spend their money. And PMIs were all higher though. They were all above 53, which again, is growth. It's positive for the economy. The EU, so ECB minutes continue to endorse their intention to hike rates further. I think they're surprised by the resilience of the Eurozone. Again, they're just getting used to it. And they believe that, this is the ECB that believes they're on a way to victory over inflation. Doubtful. I've got to say that's really doubtful. Higher wage growth is still there. Core inflation is still high and it's posing risks. And it's just not clear really of where they're going to have to take their rates to try and counter inflation and get it down. And obviously that's a main concern for all the central banks as well. And Lagarde has already outlined another 50 basis point rise in March. I mean, she came out with that after the meeting of the February one, saying that. And it looks as though she's right. Because the ECB has still got challenges when it comes to inflation. I mean, just look at the French. It came in higher again at 6.2%, which is up 0.9, almost 1% just month on month. And it looks as though it's going to go higher yet. And you know, some of the driving forces of this inflation at the moment are food, energy, and services, I would say, are probably the key impactors. Spain, their PMI has actually improved for services, and even their manufacturing was higher as well. German CPI came in stronger at 8.7% year on year, which was up 0.8% month on month. So again, you know, they're all still increasing rather than reducing. And the harmonised year on year came in at 9.3%. For the EU, their CPI was up again, as you would expect, you know, just from the way all this regional data sort of filtering through, with the core at 5.6 year on year and headline 8.5. Now, unemployment remains at their record low of 6.7%. Still on the EU, so PPI saw a big drop, down 2.8% month on month, and it's now around about 15% year on year. Now, the PMIs were slightly lower, but they were still above 50. So, you know, anything above 50 is growth. Just because it drops below 50 doesn't mean that it's contraction. It's really got to go down below the mid 40s for it to look sort of pretty bad for the economy, or looking bad, or start of, you know, a contraction for sure. Now, we saw stocks close the week stronger, as well as gold. Gold was up over 1%, finished very strong on Friday. WTI was up 2% as well, again, finished very strong Friday. Now, Treasuries, the 10-year hit 4% last week briefly. And, you know, a little bit surprising to a degree, but not when you sort of look at the fundamentals around it. Bitcoin was down 4.8%. In Australia, retail sales came in higher than expected, although Q4 GDP was lower at 0.5%, and their CPI year on year was 7.4%. For Canada, their GDP came in at flat year on year and month on month. So again, you know, just watch them. They're probably going to not be so keen to be putting their rates up at the moment. But again, you know, it looks as though maybe they are starting to gain a little bit of control over inflation if they've sort of got that happening. But you know, food prices and such like just aren't coming down very quickly. Now, interestingly, China's PMIs were much stronger than expected. Again, they was all above 50. And of course, this is as they're recovering from their lockdowns. And you know, China is or could be a big impact on inflation for the next few months for sure. Okay, so if we look at this week, so if we start with the US, Powell's testifying to Congress. It's always interesting to hear what he's got to say as they grill him about the economy, and obviously that's going to inflation's going to be the major question there, along with interest rates. And then, of course, this Friday we've got NFP as well, non-farm payroll. Also out is Michigan consumer sentiment. And the one that I like, which is the Beige Book. You know, it's not really data, but it does really give you some great insight into Fed members' outlooks of the US economy. And it's more their view rather than data driven, which is why I like it. In the UK, we've got some housing data, we've got GDP. So keep an eye on the GDP because it's sort of expected to come in low, and it could be the beginning of what could turn out to be a technical recession. Obviously, this will be the first quarter, so we've got to wait for the second. But you know, it's again, you know, everywhere seems to be quite resilient at the moment, but it's going to buckle at some stage the way things are going. We've also got in the UK industrial productions, manufacturing, and as I've mentioned, you know, there is this potential for over, you know, maybe the next 3 to 6 months, if it continues, that the UK may go into a technical recession. But, you know, the US went into a technical recession last year, and that didn't hurt them at all. It just makes you wonder whether, you know, whether we should sort of relook at some of these economics and the way that we sort of appraise them, and maybe we need to make some changes. In the EU, we've got retail sales, GDP. Germany also have retail sales, industrial production, and CPI. For Australia, you're going to have a rate decision there. Expectations are for 25 basis points. In Canada, you've got unemployment rate coming out and a rate decision. And as I mentioned earlier, it's more likely that that's going to be unchanged at the moment. And Japan, they've got GDP and also their rate decision. You know, again, they've got their sort of new head there, so it's going to take him a little bit of time. Even then, it's still a question of whether Ueda is going to actually make any change to policy. And in China, they have got CPI out, so something to keep an eye on as well. Okay, so now we're moving on to the macro outlook. As I mentioned before, stocks ended the week strong. You know, investors are adding risk on quite happily. Even gold and oil were quite a lot higher. And of course, the stock market, for me, it just still lacks sort of a clear trend. You know, investors are a little bit confused and indecisive about, you know, what's going to happen with the way central banks and the economy are balanced. You know, how aggressive are these central banks going to remain with their rate hikes? So inflation is becoming entrenched still, and of course those expectations of where those rates will finally stop continue to change, mostly from the upside, of course. You know, it's possible that the Fed could go up to or beyond even 5.5% at the moment. And will the ECB stop if it gets to 4%? I think the Bank of England's probably got less hikes to go, maybe 1 or 2 more, 25 basis point ones. And you know, again, it might just depend on if they're willing to push the economy into a deeper recession or not. So as I've already mentioned about China, so China reopening is really not helping the fight against inflation. And their data's out, you know, that's come out recently. It's just showing how quickly they're recovering. And when, you know, they're growing, you look at their PMIs, they're the highest level for a decade. I mean, non-manufacturing came in at 52 and manufacturing came in at 56. Of course, after the subprime, we was happy to sort of have them grow and demand, because you know, it helped the whole global economy to recover. This time around, though, it's a little bit different. You know, we've got so much inflation already and so much growth that central banks are struggling to control that. And so, you know, where we wanted them in the subprime, now it's working against the economies, because it's driving up demand, which again is driving up the price of the commodities. And of course, that could have a big impact on EU inflation shortly. And the reason for that is because they're both going to be competing for the LNG stocks, you know, just getting those sort of gas stocks replenished for next winter, really. Okay, so the Chinese government's doing their 2 sessions Sunday. It's going on, you know, it's where they discuss sort of the growth and such like. And they're setting a high GDP growth, which is going to be 5% or higher. So central banks, or central bankers, shall I say, just seem to be having more sort of differing opinions on how much further these rates have got to go. There was a Fed member out, Bostic. He suggested that sort of US rates could pause in the summer. Again, they're data driven, so we'll have to wait and see. But that did help the stock market rally towards the end of last week. For me, inflation's just not going to drop quickly. That's despite all the rate hikes. And I think the reason for that is because most of inflation is still coming from supply issues. You go into supermarkets and a lot of shops, their shelves aren't fully stocked for sure. And we've got food, services, and energy that are major contributors to inflation, uh, along with wages, of course, where people are trying to claim higher salaries to compensate for inflation. But of course, inflation over time will come back down, but those wages will still be there for the workers. So, which is to a degree why some of the companies are reluctant to pay these big wage demands, because the expectations are that over time there will be success and inflation will drop again. So US yields continue to rise. And again, that sort of is helping to keep the dollar steady. It finished off with its highs, but it's still steady. And even central bankers are having to come to terms that they may need to go further than they expected with rate hikes. So I've been mentioning for some time in our YouTube and daily letters, they're not just going to go higher, but they're going to stay there for longer. They're going to want to see rates at their target 2% if they can get it there for at least 3 to 6 months, I reckon, before they even sort of contemplate any change of policy. But they've still got a major fight on their hands to get that to anywhere near 2%. For me, I can't understand why they don't just increase the target rate. And I'm not saying that just because it's going to make it easier for them to have claim success. But for me, it's because so much of the inflation is still being driven from the supply issues. And until they're finally resolved, so it can be a temporary increase. It hasn't got to be permanent. And the other thing for me as well is, are the central banks really giving the economy enough time to see the full impact from the rates that they've done so far? It can take months for all this to filter through into the economy and be able to sort of measure that full impact. So, maybe they're just sort of panicking still and just going that little bit faster than perhaps they should. Which again could lead to the fact that, as Bostic said, by the summer, most of the central banks may take their foot off the accelerator and just wait and see what happens for a while. Of course, for me, again, governments and central banks should take some of the responsibility for some of this inflation. When you look at the amount of stimulus that they added over COVID, I mean, in the US, it was absolute trillions. And of course, some of those US households are still holding on to some of those savings, over $1 trillion in savings they've got. However, saying that, when you look at some of these low to sort of mid-earning households, they're definitely living paycheck to paycheck. So many central bank decisions, they're being made from this data that's being provided. And I've mentioned this before, but how can we trust that data? Because it seems that less and less are responding to their surveys. From what I can gather, for some of these surveys, there's only about a third, maximum of a half, that are actually responding. And of course, that's got to make the data less reliable. So now we're moving on to my trading tip of the week. We've been talking about data and everything, so it sort of leads on from that. So, if you're trading, especially if you're day trading or intraday trading, just make sure that you're aware of when those data releases are coming out, or if there's going to be any central bank speakers, anything effectively that can be market moving. it's easy enough to check. All you've got to do is just go onto some of these sort of websites and look at their economic calendars for the times that it comes out and make a note of it so you don't forget, or even set an alarm on your phone or something. But this data that comes out and these speakers, they're going to impact markets because all the investors are very nervous at the moment. And of course, as I mentioned, that data, is it reliable? And also something before the data's coming out, especially if you're sort of considering trading it, and just be careful about doing that. But you've got to analyze to see if it's already priced in. So, if they're expecting good data, has the market already been moving up over the last few days? Because that could mean that traders are preempting that and already taking those positions on. They're hoping to get in at a better price. So if you do lack experience on trading and the impacts of data and such like, practice on a demo to improve. Just see if you get the moves right. You've got to improve your fundamental understanding. I trade in all different ways. Fundamentals, technicals, a little bit of just basic instincts even. But I've been trading for over 4 decades, so it's no surprise. But even so, you've got to sort of make sure you do understand what's going on in these markets, and they're constantly evolving, the same as everything else. So what you expect it to be in the form of traditional macroeconomics isn't necessarily the case, especially when you've got central banks so deeply involved in these markets as they are. Okay, so now we're going to move on to the technical analysis section. Again, just a reminder, so in the right hand border, anything that's there in black, they are the support resistance levels. Brown numbers are breakout levels. Any claret numbers are just where I've sort of identified where I can see some support or resistance. It might just be a build up there, or they could be based on double or triple tops or bottoms. And then below you can see the colors for the pivot points and also Fibonacci for when I put them on. Okay, so as I mentioned, when we look at the charts, it's been one of those where we've seen a lot of movement coming through, much stronger for the stocks, and the Dow finished the week on its high, well, for the week anyway, and so I've got resistance at 34,594. I've also got resistance at 33,432. It's a downtrend line. I've got support at 32,572, and I've got the same breakout level still in there at 31,731 should the markets drop. Moving on to the 30-minute, I've got resistance at 33,458, also at 33,430, support at 33,254, 32,954, and 32,770. As we look at the S&P on the daily, I've got resistance at 41.43 and 40.55, with support at 39.27 and 38.04. It's going to break out one way or the other when you look at that from the closest support and resistance levels. And then moving on to the 30-minute, I've got resistance at 4,057 and 4,054, two quite tight lines, but taken from completely different levels. And then support I've got at 4,012, and then below that 39.93 and 39.70. 1873. Nasdaq resistance at 12,748 and 12,464. Support at 11,851 and 11,830. On the 30-minute, I've got resistance at 12,328 and I've got support at 12,272 and 12,078 and 12,073. As I usually remind, you can always take screenshots or just take pictures with your phone, especially for the dailies, because they don't change so much during the week unless there's been some serious move. Okay, moving on to the Russell, I've got resistance at 1998. I've got resistance at 1952. And then support at 1876. On the 30-minute time frame, I've got 1936 resistance with support at 1928, 1903 and also 1898. Now we're just going to look at a couple of currencies. So here's the pound against the dollar on the daily. I've got resistance at 123.19. I've also got resistance at 121.55 with support at 119.17. On the 30-minute, I've got resistance at 120.77 and 120.49, pretty much where it closed, and support at 119.74 and 119.63. Again, just keep your eye out for the GDP numbers from the UK if you're trading pound against the dollar. Moving on to the euro, I've got resistance at 108.25 and 106.89 with support at 105.89 and 105.30. So again, probably expect to break out quite quickly on that one. And the 30-minute is 106.63 resistance, 106.51 and 106.48 with support at 105.97. So if we look at Bitcoin, it had a pretty poor week, ended up on the lows. Bit of sort of fundamental news came out there, so impacted and it caused a wave of selling, a very quick wave of selling as well, as you'll see when we move on to the 30-minute. But we've got resistance at 25,310 and 23,768, support at 22,001 and 26,995. So there you can see that big sharp move that happened within an hour. And so resistance I've got at 23,605 and 23,527. And I've got support at 22,160. It just sort of ended up the day consolidating once it had that big move, as people are considering, traders are working out where it's going to go next now and how much impact that news is going to have. So when we sort of look at Bitcoin against Nasdaq, where those correlations were getting tighter. As the last few weeks I've put it on a 30-minute, but this week I've moved it back to a daily, so you can see that they're actually sort of inverse moves going on there at the moment. Okay, so gold again finished the week strong. $50 rally on the week is pretty good. So okay, so I've got resistance now at 1942 and below that 1864, and I've got support at 1808 and 1807. The 30-minute is showing 1864 as a resistance, the same as the daily, and support at 1843 and 1835. Finally, moving on to WTI. For me, it's still ranging at the moment. It's still in that $72, $82 range. I've got resistance at 82.60 and 79.93, with support at 75.68 and 74.47. On the 30-minute, I've got resistance at 79.91, similar to the daily, with support at 78.74, 77.28 and 75.84. So yeah, we've got central bank meetings coming out this month as well. So just keep an eye on those. It's going to sort of impact all of these markets. You've got Powell speaking. There's lots and lots going on. Never a dull moment in trading at the moment. So just a reminder of what we do, where we can help you with your trading, some of our services. So apart from obviously this YouTube, we offer a daily newsletter, and in there you get sort of the global headlines, you get my views, you also get fresh daily chart levels, and that includes fresh pivot points each day. And we give you full package, so you get a lot of sort of detailed news as well, global news, and it's definitely worth signing up for, and that's where you would sign up on there. Then we do one-day workshops, and you can just use these to fill in any gaps that you've got, which is obviously going to help you to accelerate your trading experience and improve your skills as well. And then our 1 week course pretty much takes you from 0 to hero. Obviously it depends where you are in your trading career, but it's a great course to give you those foundations on which you're going to build that trading career. And then if you're really serious about turning it into a career, rather than just maybe a second income, then we do our comprehensive masterclass. It's an accredited course, and that's designed to provide you all the knowledge and trading skills that you're going to need to navigate today's markets. And we cover all the asset classes as well. And then moving on, just check out our calendar, or reach out to us to find out what's coming up, because we do change them from time to time. Especially in the order that they're coming. Trader mentoring. So if you want to get to that next level, then we can definitely help you with that. I've got almost 50 years of trading experience, so I'm happy to pass some of that on. And sometimes you just need that sort of other set of eyes looking at what you're doing to help you to achieve that. We consult hedging for FX, commodity exposure, companies, individuals and such like. And then of course we provide trader education, and that can be to individuals, also to exchanges and brokers. So again, if you're looking to improve, then check us out. Look on our website. Just contact me. Otherwise, send me an email. I'm happy to arrange a discussion and see if and where we can help you. And then of course, if you lack the capital to do this, as many do, they tend to try and trade when they're undercapitalized, then you can do that, or at least have a go at qualifying for that through our partner to get that funded trading account, which again saves you having to use your capital for that. And if you would like to reach out to us, quite simply, info@cymaxfintech.com, or if you've got something that you'd like to ask me about trading, then it's chris.tubby@cymax-int.com. So as usual, listen, have a great week trading. If you've got any questions, then reach out, and good luck. And of course, above all, be lucky. Bye for now.